Happy Wednesday. Welcome to another edition of hashtag ASKROBCO. Hope you are well. Hope you all had a good week. So much to talk about. We didn't get through your questions last week because we had a very quick fire session. We had such great information and such great data that we had to get it over to you. This week, we can definitely get through more questions. So you know the format. On the right-hand side, you've got the questions button. If you type in your question, whatever you wish to discuss, please type it in and we will give you the answers. James is with us again this week. Hi, James. How are you?
Yeah, really good. Thanks, Rob. Really good. Hello, everyone.
Excellent, excellent. Okay, so get your questions through on the right-hand side and we will go through everything with you. Property market moving super fast. A week in property. I don't know if it's the same as a week in politics, definitely not, but for sure within the property market, daily movements, daily activity. And as you know, we are here to share with you the insight that we see on a daily basis: data, intel, sales, risk, product, pricing, activity, uncertainty, everything that we're seeing within the system, infrastructure of mortgage lending and sales and activity and risk and underwriting, we are sharing with you. And all the questions that you've got, please get over to us. We've got some really good information today. So I think we're going to go straight in with some of the handouts and go straight into the data, and let's crack on with that. I think this week we're going to start with the mortgage approvals. I think it's really important. So that's your first handout in the handout section. If you click on the button, you'll see the official numbers that were released yesterday. And, you know, the numbers really confirm everything that I've been telling you over the last weeks about the buoyancy of the market. And we've seen a jump of mortgage approvals, which is a 13-year high of 84,700 in the month of August. And I can pretty much guarantee now that that figure is going to go up and go north for the month of September, because the amount of transactions and volumes, and when we go through that data shortly after this, that we're seeing on a daily basis is telling us that August was a 13-year high, and that is only going to increase and get stronger. And that is all on the back of the, I suppose, mini boom that has been created by the government stamp duty holiday and the pent-up demand that happened during lockdown. And now we're moving into October. The questions are the following. If the pent-up demand has now been soaked through, because, you know, we got out of lockdown in May, so June, July, August, September, 4 months, that's enough to see through all of those sales that got held up. October, November, December of this year, the last quarter, is like the moment of truth where we get to see how sustainable this current market, this current mini boom is, and does it have real legs and growth, and will it carry on, or will the hard economic data of furlough and unemployment uproot or slow down that movement? I'd like to look at handout number 3, if that's okay, because handout number 3 is a 25-year overview of monthly mortgage approvals. And I think you get a really nice macro context of where we are at the moment. So for those of you who can't see or don't have this information, I'll talk you through it. The last 10 years, so let's go back to Lehman's crashing and where we are today, you would have seen a fall of Lehman's to around 30,000 monthly mortgage approvals for home purchases. And then steadily, the mean and the average over the decade from 2010 to 2020 would have hovered around the 60, 70,000 per month. Very consistent, especially from 2014 to 2020. Now we're at 85,000 approximately. There's a very good chance we're going to break through to 100,000 in September. Second we get that data, we will share it with you. And in context with the last 25 years, and so let's go back to the early 90s or mid 90s, and then the boom that we saw in 06, 07, and then the crash in 08. When we see those numbers, to put a bit of context, we were 120,000 mortgage approvals for purchases in the UK. And those numbers show buoyancy, huge activity in the market. What I would like to see, or I'm interested in seeing, is, are we going to reach those numbers? I believe we will break the 100,000 barrier, which hasn't been hit and since the 06, 07 figures. If we see that in the next month or two, does it have any legs, or is it we're reaching a peak again and then there could be a possible fall further down the line? James, any additions to the data here? Anything else you'd like to discuss?
Yeah, I think it's great data, Rob, and I think this is a further rebuttal to some of the information which we brought you in terms of instructions to the market, under offer properties through our data which we've produced for you. And again, it leads on from those climbing transactional volumes which we've been sharing over the last few months. And I think what the advantage to this data is with the mortgage approvals is there's it comes slightly prior to obviously the transaction volume spike. So this is a really good indicator of how the market is currently performing and how buyers are reacting and the activity in the market.
Excellent. Thanks for that, James. I mean, lending in August reported, I think, by the Bank of England, was slightly down on the previous month, and that's a concern about people getting credit or borrowing further. And again, when the next batch of sales figures get to come through, it would be good to understand the position of lending, debt, mortgages, and how that compares with furlough expiring and potential rising unemployment. All of these are super interesting data and information that we just got to keep tracking, keep sharing, keep discussing. Any questions you've got relating to any of this, please do put them through. We will answer them either within the answers that we're giving or answer them directly, depending on what the question is. Let's move over to handout number 3, which is our weekly data that we go through with you. Sorry, number 2, I do apologize. So let's open that one up, and that's our latest figures, week 27 post-lockdown. We're over half a year now since the infamous 24th of March lockdown. And although things are not looking so great with the COVID situation, and we're on the verge of a semi-lockdown or returning to some kind of lockdown as the numbers surge, let's see where we are with the sales numbers. So week 38 of the year, 21st of September. Remember last week, and for those of you that didn't hear, we hit record numbers, or second best week of the year of instructions coming through on the back of a couple of quiet weeks in August for the holiday season. Those numbers have softened again this week. So 539 instructions on the back of 2 very, very strong weeks of instructions. And the sales figures on it, again, just to report on last week's numbers, the highest sales of the entire year on last week's numbers, and this week's have pretty backed that up. We're at 183, which is in the top half a dozen weeks of the entire year. So week 38, and we've had one of the top 5 or 6 sales weeks. I expect that to continue. I expect those sales volumes for the next 2, 3, 4 weeks to continue. Why do I expect them to continue? Because we're on the ground, we're doing the valuations, and we are seeing a huge volume of mortgage valuations for acquisitions and purchases coming through. And that can only mean those numbers are going to be strong and remain strong, because when we do the valuation and it goes through to conveyancing, we're coming in at either exchange or just before exchange, or sometimes in between exchange and completion, depending on how the transaction is being managed. And that's before a lot of the data feeds through, definitely through the data that we're giving you, which a lot of it is exchange, but well before what you're going to see on land registry, which is, again, months, 2, 3 months, sometimes longer down the line. So we're just telling you that we're seeing lots of evidence, lots of transactions, and some interesting numbers that have come out from August moving into September. Seeing very strong sales above a million, prime, secondary prime marketplaces, and a big increase than what we're seeing in the like for like a year ago in terms of volume. And below a million, in London especially, those numbers are slightly lower. So we've seen an increase in prime, super prime, and secondary prime above a million, where a lot of the money is going, and a small decrease on like for like a year ago below a million. James, what are your thoughts on that? I'll give my opinion afterwards.
Yeah, I mean, I think the key statistics here are obviously the under offer properties, which has remained within the upper quartile of the figures, and also the sold numbers, which is reasonably positive, and again in these upper quartile of the figures. Whilst there has been fewer instructions this week, we're still not seeing any sort of worrying stock shortages, and we are really just sort of getting the wheels in motion for this final quarter of the year, which hopefully will be positive, and those instruction numbers will not fall off. They'll remain broadly stable now.
Definitely. I mean, just to conclude and reiterate that point, a week ago we said we saw the highest amount of sales transactions for the entire year, on the back of the bounce, the mini boom, the stamp duty holiday, pent-up demand, all of those contributors, and also the highest amount, more or less, of instructions coming through. It's not slowing down. We're seeing a huge amount of volume at valuation level, and what we're feeding to you at the moment is, I would say, a very hot, frothy marketplace with great activity. So everyone in sales, super excited, great news, great activity. Everyone in risk, a bit of a red flag, a bit of a concern, because instead of your worry being prices are coming in, and we're seeing, many of you were writing, what's the decline? Is it 5%? Is it 10%? What's the reduction? Well, actually, what we're seeing is maybe it's a 1 or 2 or 3% increase in values that are being paid at this moment in time. And we're seeing premiums being paid. And I mentioned this last week. It was the key point from last week, is we're seeing a lot of off-market transactions where premiums are being paid, where some values can be supported and are, with good transparent evidence, but some are not supported through comparable evidence. Thus, a decision needs to be made by the purchaser and the lender whether they're happy to pay that price and pay the premium, or they want to renegotiate because they feel that what they're doing is overpaying. So from a credit, a risk, and a sanction perspective, the challenge you're facing at the moment is probably the absolute reverse to what you would have been thinking 2 or 3 months ago. 2 or 3 months ago, you're thinking prices are coming in, possibly. How am I managing my LTVs in a falling market? Well, actually, now you've got the reverse. You've got possibly inflated pricing, hot market, a buoyant market where people are paying a premium, and you've got to manage your risk exposure and your LTV to that position and situation rather than the other way around. Now, why is that happening? And again, anyone that has a viewpoint, please do share. And I'm just throwing it to James. One of the reasons is the following. People are very concerned. Everyone in risk and credit, you probably don't want to hear this, or you don't want your bosses to hear this, or you don't want people very high up the banks to hear this. And everyone in sales is probably what you do want to be hearing. So a lot of people are thinking 2021 is going to bring around a lot of uncertainty, a lot of volatility, and a lot of job insecurity. So I'd rather refinance or purchase an upsize to my new home, possibly in a suburb or secondary prime or prime, with my garden and my outdoor space and my house compared to maybe my flat. I'd rather do it now whilst I have good savings, I have excellent credit, I've got great mortgage product being provided to the market with very, very low rates, virtually zero in terms of negative rates. I'd rather overpay now by 100,000, 200,000, 500,000, possibly even a million as you go into prime, super prime market. I'd rather overpay and secure my next 5 years, maybe 10 years, depending on how you're doing your finances. I'd rather secure my position now and my move on the back of my own security, of my own finances, and my excellent credit rating and position on the back of where I am today, than the risk of 6, 12 months down the line, me not being in such a good position. And maybe, because we discussed the week before last, borrowing costs and how they're edging very slightly up, and maybe that could be a trend. So why would I risk higher borrowing costs and maybe less certainty with my own financial and job security? I'd rather take the plunge now and overpay. Now, that's a viewpoint. I believe a certain percentage of the market is definitely acting that way. And you've got to think logically. Why would people be paying premiums and overpaying in the current midst of no security or less security, uncertainty, and volatility, unless they believe that it was a good moment for them in sentiment to do such a move? James.
Rob, thanks very much for those points. I had just a brief discussion point I wanted to raise with you. And again, it follows on from your points in relation to sort of where buyers want to be at this time, where they're moving to and from. And it's whether you thought sort of some of the commuter hubs, as we know them, just on the outskirts of London, do you think they could suffer at all as a result of changing logistics of workers and what they're looking for in properties and their sort of needs moving forward? And just to give you a bit more flavour, I'm talking of areas such as those commuter districts just in the north. You've got Harpenden, St Albans, you've got the Surrey corridor, you've possibly got Cambridge coming slightly further out. All these commuter hubs that all lead straight into London with great transport links.
I mean, what I like about the question and those marketplaces, those commuter hubs, is on one side they've done very well as being a great access to London, like you said, with great transportation links, and also cheaper places to live and arguably more attractive places to live with better quality of life and living. At the same time, if people are still going to require to go into London, even if it's ad hoc meetings, whether it's once a week, fortnightly, every month, they're still going to have to rely upon that. So arguably, they could even strengthen, because even more people would want to be in the commuter belt or the commuter hubs like you've mentioned, because they become even more attractive. They could be like the home county moves that we're seeing, of people getting their out of London home. So the argument could be they could even strengthen on the back of what's going on now. And I think there's a good chance that that's what we're going to see.
Yeah, no, thank you, Rob. And I think that they're sort of possibly in more central London, you're sort of, zone 3 inwards, there is less pressure to be on the doorstep of a tube. But as you move out of London, you will get that sort of donut effect, like you say, of people actually, there'll be a lot of people moving further out of London to get that sort of more outside space, and obviously less requirement to be in more central London. So an interesting one to monitor in the coming months.
Absolutely. I mean, where the market is at the moment it's fascinating. Sorry, keep your questions coming through, and we'll get through the last few in the last 5 minutes. Where the marketplace is at the moment, it's absolutely fascinating. Tomorrow we're hitting the 1st of August. We're 27 weeks post lockdown now. I think with the hashtag AskRobCo show on a Wednesday, we're probably 20 weeks into the program, if not more. And I remember the uncertainty and the questions that you were asking about what the marketplace was going to look like moving forward when we came out of lockdown, and was there going to be a big crash and a deep dive, and was the market sustainable? And I don't believe, and I think everyone's got to be fair and open, I don't believe that anyone could have predicted that going into the 1st of October, we'd be seeing such a buoyant market with such incredible activity on the back of a 13-year high on mortgage approvals, which I'm convinced that in a month's time we're going to see increase even more. And we're in the midst of a second wave of a pandemic going into a winter that's going to be very challenging in terms of health and well-being and the COVID scenario, as well as the economy, market conditions, and the uncertainty and volatility that goes with all of that.
Yeah.
A couple of other points I want to finish before we close out today. The rental market, especially in London, is suffering. And rents are coming down. People are leaving properties and negotiating harder on their rents and looking for outdoor space. And that whole market is looking different to what it looked like 6 months ago.
Yeah, I think tenants are certainly, those which are coming up to renewal are prioritizing outside space, and also their sort of requirement again to be in that location where they're based. And landlords are again under pressure from tenants. And we also mentioned in previous weeks about some rental arrears. So it's a really difficult market at the moment, the lettings market as we're seeing it.
Yeah, I mean, rental figures are down. People are not renewing as much as they were. They're looking for cheaper accommodation, different accommodation, not so London-centric. Buy-to-let offering is going to be interesting to see how that market moves, pricing for that product, yields, etc. And I think, James, you had something on a couple of product movements to update the market on.
Yeah, just a quick update. As we were mentioning, Rob, the mortgage market is extremely competitive at the moment. I know the buy-to-let specialist Fleet Mortgages has cut their rates across a number of their products, including a new mortgage sort of range of products, which is a base rate tracker mortgages. Again, precise mortgages have broadened its range of bridging finance options, increasing LTVs to 65% on a number of their heavy refurb and light refurb products, with their rates starting at around 0.49% on a monthly basis. So again, highlighting the competitiveness in the mortgage market, which I think leads on from the figures which we were discussing earlier in the show.
Brilliant. Excellent. Thanks for that, James. Okay, to just close things out and make sure I answer the final questions. Headline economists and researchers are predicting the possibility of March, April, May of next year of the property market potentially coming to a head and crashing and falling. I think that those same people would have been predicting that in September 2020 that would have happened, and it clearly hasn't. It's going to be very uncertain, very volatile. For all of you in credit and risk on the call, you've really got to keep your finger on the pulse. You've got to know what's going on week for week. You've got to be following these trends and patterns and understand where you need to red flag and where you maybe are more comfortable to be lending, more secure, long-term view on certain products, and maybe other products being very short-term. And at the same time, I think that from the sales perspective, everyone should appreciate that the markets are strong, agents are doing phenomenally well, and the volumes look like they're going to continue to grow. And I think September will have very, very strong official numbers because we've seen the volume that's going on the ground at the moment, and that isn't stopping at this moment in time. Brilliant. Thanks everyone coming. Thanks for your great questions today. All the platforms, LinkedIn, YouTube, Instagram, hashtag ASKROBCO, share with your colleagues. You can watch afterwards. If you want any of the data and information, please contact us. We'll share it with you, and we will see you same time, same place next week. James, final word?
Yeah, I just want to have a very quick final word, just in terms of the macroeconomic climate at the moment. And we know that today Shell have cut around 9,000 jobs. TSB have closed a number of their high street stores, 164. Walt Disney have cut 28,000 jobs. So whilst negativity somewhat looms from a macro perspective, we know that nationwide, as this week reported, house price growth of 5%, which is the highest since September 2016. So on the back of that, the housing market continues to be resilient and perform very, very well.
Brilliant. See, positivity and uncertainty can happen simultaneously at the same time. Thanks everyone for joining. Have a great week. Be safe, be healthy. We will see you all again next week at 1 o'clock next Wednesday. Hashtag AskRobCo. Take care, everyone. Thank you. Thanks, James.
Thanks very much.